In 2023, £700 million worth of CCJs were issued.
I think a lot of people want to die on the hill of principle.
Yeah.
Like a phone bill. Oh, I'm not paying that.
I'm not paying that, etc.
I fell out with EE.
Not a lot of people realize companies dislike overdrafts more than they will ever dislike a credit card because your overdraft is attached to your bank account. So the perspective is that if you're living in your overdraft, you actually haven't got enough money coming in, period. A credit card is additional money. So that's you just maybe not being as responsible, relying too heavy on that credit card, but it doesn't mean that you can't afford your expenses. It just means that maybe you like to travel to Selfridges a bit too often or have too many takeaways or go out too often. So that's discipline that can be instilled. But overdraft, if you can stay out of your overdraft, then that's the first thing that I would recommend.
What are some of the most common mistakes that people make around credit and nurturing their credit?
I would say
Welcome back to another episode of the PBK podcast. Each and every week, we have a special guest where we talk all things property and things property related. Now, today I have Ella Weinberg. Have I said that correctly?
yes, you have. Well done.
Where's your name from?
My surname is Dutch. My dad is Dutch and Latvian.
Okay. And mum?
Jamaican.
Okay, nice. I never would have guessed that. But interesting.
Thank you.
Now, I've got you on to talk about a topic that everyone finds so interesting.
Really?
No, but we're going to make it
Okay,
interesting.
all right,
and
cool.
we're going to highlight the importance of it.
Okay. Let's do
So
it.
what is it that you do?
I am a finance expert, but my specialist area, let's say, is insurance. So all things personal protection, business protection, life insurance, critical illness, income protection, relevant life, private healthcare, etc. I then support clients in building their credit score, getting their mortgage ready, so to speak, estate planning a little, and then financial coaching too.
Okay, so quite a wide berth of topic. Oh, this is going to be fun. So as a starting point,
Yes.
when we're talking about finance and being a finance expert, where do you think is the most common place that people are lacking when it comes to their financial literacy?
Probably just general knowledge all over. I feel like people can get quite comfortable in one particular area and will hone in. People can get they'll hone in specifically on pensions. Will know exactly where their pension is, how they can accumulate it all into one pot, but then will lack the basic understanding of which savings account they should have. You know, the difference between a high yield saving or a low yield saving, an emergency fund. So I think it's just financial literacy across the board. Having said that though, my field, insurance, I would say is definitely covered the least, and especially by the finance industry itself. Like when we think of financial advisors, they don't even cover insurance a lot. When we think of mortgage brokers who are qualified to do insurance, they don't do it a lot. So I do think information being readily available when it comes to insurance is significantly lacking.
Yeah, I think if it wasn't for meeting you and a couple people in your field, a lot of the things that I consider myself someone that's quite financially literate. I just think doesn't concern me. So like, for example, what is the general response when you talk to people about maybe pensions and the importance of a pension?
I don't speak about it that much in terms of the work that I do, but it's definitely something that comes up. If I'm being totally transparent, I think everyone should have a pension. Who wants to not take advantage of free money? Yes, of course, you contribute a certain amount into your pension, but then that accrues in interest by a certain amount. But I do think that there are just more modern ways that when it comes to growing your wealth, like property, like investing, building a business, like people are developing side hustles now so much more than they ever were before. Yeah. I just think that there's other routes than going down the traditional archaic route of a pension.
Yeah, I think it's the argument of sort of saving versus investing almost.
Yeah.
For a lot of people. And when I talk to people and they're like, look, I've got X amount of money and I don't want to sound condescending, like how can I get to this point? I think it's quite patronizing when the government put out things like, oh, you should use the kettle less. And you should maybe not go to Costa once a week, and that's how.
Yeah, and if you save your Starbucks, you'll then have this amount of money by the end of the year. And yeah, 100%, it is condescending.
And I think, you know, there are so many opportunities, like you said, that you can turn hustles into real full-time businesses.
Yeah.
Okay, so let's get to a point that I think, or a conversation I think a lot of people miss out. And we talk about it, and I've spoke about it recently. I've seen you have credit. How
Okay.
important is your credit score?
To me, it's number one.
Yeah.
You get a credit report like literally from, I think it's about the age of 16, kind of varies from individual. The problem that I'm noticing, having done a bit of work with, like, say, schools and universities and colleges, is people are not taking advantage of their credit correctly, or they've abused their credit and then they're taking advantage of their children's credit,
Yeah.
for example. So people don't appreciate the power of what credit does until it's too late. And then they're in a position where it's like, now I want to fix my credit. But the reality is your credit is used for everything. It's like a financial CV. If you want to rent, credit. If you want to get a credit card, credit. If you want to get a mortgage, credit. If someone just wants to understand how viable you are as an individual, that can even just be going into a particular role. Credit. They're going to have a look at your credit report.
Yeah, I think, like I say, it's your personal CV. And it also, particularly in the property space, it allows you to leverage. Because
Exactly.
if I've got £100,000, I'm thinking, look, I'm doing super well for myself. I've got £100,000 like cash or liquid.
Yeah.
But if you've got zero credit, that's the extent of how you can utilize that money.
Yeah.
And at a point in time when property prices were, rapidly increasing, every year that you own a property and it was going up by, 4, 5, sometimes even like higher percentage points. But if you own assets where you've leveraged, so i.e. that £100,000, you're now controlling £400,000 worth of assets.
Exactly.
Collectively, your money's increasing at a faster rate.
Yeah. Yeah.
What are some of the most common mistakes that people make around credit and nurturing their credit?
I would say, first of all, not knowing where to look. I think that's definitely number one. I have conversations with clients and they're like, I checked my credit report with Experian. I checked my credit report with Equifax, but that's just one platform, one agency. There's 3 different agencies. There's a platform called Check My File. A lot of mortgage brokers use it because that gives you a 360-degree view of what your credit report looks like with all of the agencies. What's reported on one might not be reported on the other. So that's when a lot of CCJs might get missed, a default, payment, etc., maybe even the whole account. So I would definitely say that's number one, because it's just giving you a false perspective of what your credit report looks like. Definitely, yeah, number one. Number two is just not respecting that if you don't pay things on time, then you're going to get landed with a missed payment.
Yeah, like I think a lot of people want to die on the hill of principle.
Yeah.
Like a phone bill. Oh, I'm not paying that.
I'm
like,
not paying that, etc.
I fell out with EE or whoever it is at
Yeah.
the time, and so I'm not paying that. But the reality is sometimes that the cost implication of that versus just paying it and arguing it afterwards can have massive ramifications.
Yeah,
in the long
100%.
term.
Because if you think of it from the perspective of a missed payment, anything within your immediate last 6 months is what impacts your credit score the most. However, lenders, mortgage lenders, etc., they're all looking at your credit report within the last 2 years. So even though 6 months might have passed now, you're thinking, oh, I've put that relationship with EE to bed, it doesn't matter. It's still everything that's going on in the last 2 years that they're taking significantly into consideration. But then if we think about negative credit, adverse credit, things like missed payments, defaults, CCJs, any type of account stays on your credit report for at least 6 years. The reason why I say at least 6 years is because it's supposed to be 6, but now I'm noticing more and more that reports are staying on there, say up until about 7, sometimes potentially 8, unless you're in a position to argue and say, hey, look, you were supposed to update this, take it off.
Yeah.
But that's a long time.
Yeah, no, it is. So it's like in terms of not being on top of things, and that's where I think administration and just being aware of implications are massively important. I've told this story a number of times, but I always tell it again because it costs me money and it's a pain point and it's somewhere that I learned that I've just got to be organized.
Yeah.
With owning property, we own things where we have utility bills. Sometimes they're supposed to be in a company name, but end up in your name.
Yeah.
And it was literally like a £40 like
Yeah,
EDF
always
bill
is.
for a property that I'd sold. I forgot to update a correspondence address, so didn't hear about it. Ended up counting as like a missed payment for 3 months. And the implication that had was the mortgage provider was now saying that I wanted to use that had amazing rates at the time. This was sort of pre-lockdown when rates were super low. We're like, well, we can't use you. So then I can't use them, sorry. So then I think it ended up meaning I had to use another provider. It was quite a sizable mortgage, maybe a £300 different on a monthly payment.
Do you see what I'm saying?
And that across a
£300.
5-year term.
Exactly. Do the difference between the £40 bill that could have been paid
Yeah.
in the first place. Yeah, 100%. And I think if we're thinking of the average person that's not in your position, so hasn't got multiple properties, hasn't got multiple utility bills, bottom line is if you're on top of your finances, you don't have to worry about the administration. The hard work's been taken care of because your bills are being paid on time, your direct debits are up to date. If your internal finances, your expenses are all on point, your credit report's going to be on point too.
What do you think about people that just think, well, my credit must be great because I just don't use any credit?
Yeah, that's a big misconception as well, because how can people rate you in terms of your financial CV if there's nothing to rate? Because bottom line is it's all about understanding how responsible you are with money. If you've never had money, no one's got anything to gauge it on. So that's another big misconception, that if you've never got any credit, if you've never taken out an account on credit, so for example phone bills, not necessarily utility bills, but broadband, loans, anything like that, an overdraft, if you've got nothing on credit, it doesn't necessarily mean that you're financially responsible. Why? Because you're not using anyone else's money. You might be financially responsible with your own, but from a lender's perspective, it's knowing how responsible you're going to be with their money at the end of the
They
day.
haven't seen it. You got no track record.
Nothing.
What are some of the things that people can do to either improve their credit, or just help, just build credit if they don't have it already?
I would say improve credit is definitely knowing where to look, understanding exactly where you're at. So all of the accounts, making sure that your information is correct, putting all of those accounts that can be impacted on your credit report on a direct debit. Try and make sure that your direct debit is on the same day every month, all of them one time. So if you get paid on the 27th, all of your direct debits come out on the 28th. Then the rest of the money that's left in your account is yours.
Do you know what? No, that's the feeling of like all your money coming out is sad. I remember when I'm on holidays, and then randomly I just see it feels like one of them pointless games that all my money's just drained.
I hear you, but that money that's come in, it's not yours.
Yeah.
It's EE's.
But I've
It's
seen
Thames
it.
Water.
Right, let it be mine for a little while.
No, because then if it's yours for a little while, are you not going to spend it for a little while? And the problem is it's not coming back until next month.
Yeah, no, it
A lot
does
of
make
people
a
are
lot
on a
of sense.
28-day payday cycle, so
Yeah. Now, sometimes I like to see, want to see the money for a
you
little
want to see
while.
the money.
But I think it does make a lot more sense if you can be organized, because whether it's with council tax, they'll say, what day do you want to set your direct debit up on? And if you have, it's all about making your life as easy as possible.
Yeah.
If you standardize it,
Yeah.
get paid this day, money goes out that day. That day means I can spend relatively carefree.
Exactly. I tell my clients, literally have a separate account, have a fun account, 3 bank accounts, one account that you get paid into, your direct debits come out, another account, variable expenditure, things like petrol, food, because they can vary, etc. You have a budget, you transfer it over, you don't need to worry. Then you have another account that you transfer over, whatever the amount is, that is yours. You're free to spend. If you blow it all in 24 hours, no one cares because your direct debits are paid. You haven't had to worry about a thing. But going back to what you were saying in terms of improving, definitely being organized. And then the second thing is just trying to manage each account. So for example, if you have got a missed payment, I think a big misconception is...
Thank you to those of you who have liked, shared, commented, but most importantly, subscribed to the channel. Did you know only 28% of people that regularly watch my videos have subscribed? Now we're trying to get that to 40% so we can bring on bigger and better guests and make better content for you. So if you could do that right now, myself and my team would really appreciate it. Now back to the video.
Not a lot of people realize that they can argue to some extent, making sure that if you received a mispayment is fair. If it's one mispayment, call them up. Say, look, I've got a brilliant track record with you for the last 6 years. I've never missed a payment. It happened this one time. The companies have a legal obligation to update your report accurately and fairly. So if it's once and it's within a certain day period, 9 times out of 10, you can argue the mispayment. Do it. Because the stress of having that on your report for however long, it's not worth it.
Yeah, no, definitely. What about credit utilization? A lot of people get their credit card and say, Selfridge is looking good today.
Yeah.
where is like, or they live in their overdraft.
Yeah.
Where is like a reasonable amount in terms of overdraft credit cards, what the companies like and dislike?
So first of all, companies dislike overdrafts more than they will ever dislike a credit card. Because if you think about it like this, your overdraft is attached to your bank account. So the perspective is that if you're living in your overdraft, you actually haven't got enough money coming in, period. A credit card is additional money. So that's you just maybe not being as responsible, relying too heavy on that credit card, but it doesn't mean that you can't afford your expenses. It just means that maybe you like to travel to Selfridges a bit too often, or have too many takeaways, or go out too often. So that's discipline that can be instilled. But overdraft, if you can stay out of your overdraft, then that's the first thing that I would recommend. There's loads of different arguments when it comes to the credit utilization, stay below 40%, 30%. I would say if you're in a position where you're trying to improve your credit and you've actively got a balance on your credit card or your overdraft, get to 40% as quickly as you can, because 40% basically says, I'm not relying on credit, I'm below the 50% threshold. From there, just bring it down as much as you can, just be in that sort of debt reduction stage where you're trying to reduce it as much as you can. But bottom line is, if you're not holding a balance, you're always going to be in the best position possible. If credit cards see you using their money and paying it back straight away, they're gonna throw money at you.
Yeah, they give you some ridiculous limits to the point I'm like, I could run, right?
Yeah. like leave country and never pay this.
Amex will give you a limit where you say, nah, you're testing me. You want to see what I'm going to do here.
Yeah. And they do, because they make money off the interest. So they do.
And that's why I think when it comes to using credit, there's nothing wrong with using it, but use it smart, play the game.
Yeah.
So if you can use it and like you're in a position where you don't spend money you don't have, you just happen to use your Amex because you're building up the air miles, you're building up your points for your companion voucher, that you're actually, for whatever that fee is that you're paying, you make them pay you back in benefits.
Exactly. We call this credit arbitrage. So it's like you said, literally leveraging your credit so it makes sense for you. If you know that you've got £3,000 that you're being paid, and for example, your expenses are £2,000, non-credit related, you can't pay your mortgage on your credit card or your car finance or whatever. If you're in a position to spend that £2,000 on your credit card, but you know that you get paid $3,000, so you already know that you can more than afford that credit card, spend it on the credit card, because the points and the rewards that you're going to get, you're basically getting them for free.
That's why it's good to be the organized friend, when I book the holidays and I'm like, don't worry, everyone send me the money.
Yeah. Let me pay on my credit card.
Yeah. So that's where you get the bonus of being, I know it's a thankless task being the one that has to organize the holidays.
Yeah.
But if you're the one that says, look, I'll book the flights, I'll book the villa, don't worry, everyone send me, get in advance. Like, you know what I mean? Don't trust all your friends and just run off a crazy bill. But, okay, next thing I want to talk about, still credit related.
Cool.
CCJs.
Yes.
How bad is a CCJ?
Okay, no, I preempted your question. It's bad in the sense that it's so unnecessary. That's why it's bad. And it's bad in the sense of, it's just so, you know what it is? For me, it's the amount of money that the government are making through giving and issuing people with CCJs. Last quarter, not even for the year, in 2023, for one quarter, £700 million worth of CCJs were issued. 9 times out of 10, that's going to be a parking ticket. You can only get a CCJ from a parking ticket if it's private land.
That's personal. Let's not talk
about... Yeah, but I feel like you abuse the council parking tickets, not so much private land.
Nah.
Yeah.
Yeah.
So that's different. Okay. They're going to be chasing you and they're going to be hounding you, obviously if you don't pay, for example, but you're not going to get a CCJ.
Okay.
Private land now, because this is now like an agreement between you and the owner of that land or whatever, they are in a position to basically give you a CCJ. Obviously, if you don't pay something, and then as we know, if it's less than £10,000, if I owe you money and I don't pay you, you can give me a CCJ. But bottom line is the court papers come through and they say you've got 14 days, 28 days to acknowledge this court paper, etc., etc. What's your side of the story? And people are just ignoring the letters. They're burying their head in the sand thinking, let me just ignore it, CCJ. And now from your perspective as well, when we're thinking of something like a mortgage, if you are dealing with 5 lenders, the number of lenders that you've got to choose from that are going to accept you, A, with a CCJ, or the rate that they're going to offer you with that CCJ in place, definitely think credit's changed a lot over the years. Back in the day when you had adverse credit, it was a lot harder, whereas now I feel like lenders are more flexible in terms of what they offer. Not saying that it's great, but there's more flexibility. You can still, yeah.
I think that is a misconception that some people, once they get a CCJ, they're like, well, I've got to write my next 6 years off.
Yeah, that's it. I'm done for. Like, there's nothing can be done. And now in this modern day, I would say, no, you're not. But the cost of having, for example, a £285 CCJ on your account versus what you're now going to spend in fees because you didn't bother to acknowledge the CCJ is wild.
Yeah.
Is
And
wild.
I think also another thing that people don't know is if you do, let's say for whatever, you were on holiday, you missed the court papers, you missed it.
Yeah.
There is still something you can do if you've just got a CCJ, right?
100%. Even if you haven't just got it. So a lot of my clients, they, for example, because I will do CCJ applications and appeals for them, but like free gems, go to Northampton County Court, file an N244, and that allows you to basically make an application to get the CCJ reversed.
Oh, so you can.
You can 100% appeal it, you know, either one day after receiving the CCJ, you can appeal it, right up until the 6-year mark. I usually say that in the last year, it's not worth it because you're literally counting down the number of months before it's then taken off. First of all, if you are in the 6th year of a CCJ being present on your credit report, still have a conversation with the company. Don't think that just because it's the 6 years, that's it. You're out there free from the CCJ because the court or the company, can sell that debt to someone else and they can slap you with a CCJ. So definitely communicate with whoever you owe the money to, put in place some sort of payment plan or argue in your defense if you don't owe them the money. So that's number one. If it's anywhere between day 1 and year 5, 100% appeal the CCJ. If it's been sent to the wrong address, if there's certain circumstances, if they haven't sent you all of the paperwork, there are a number of reasons why you can appeal a CCJ. Main thing that you have to consider is it's not whether you owe the money, it's whether the court's judgment is fair. So forget the fact that you might owe the debt. Forget the fact that you didn't pay these people. Sometimes you haven't paid them because they genuinely didn't send you the paperwork to pay them. That's not fair that you're now issued a court judgment for 6 years and you're penalised when you're more than happy to pay someone, but they're just not doing their end of the bargain by sending you the paperwork. So yeah, definitely appeal it, number 1, and don't think that you can't get credit if you've got a CCJ for number 2.
Yeah, some good. I think a lot of people do just get the CCJ and they think,
that's it. I'm written off
I'm
financially.
Done. I'm done. I can't even tell no one. And I think it's good. I think a lot of people don't know that you can actually potentially, in the right circumstances, get them removed. Also, I think if you pay, say for example, it's something quite small, and you're in a position where you can manage the amount, even if you're in dispute, if you pay it within the first 30 days, I believe,
they'll take it off.
It gets removed.
100%, yeah. So if you don't acknowledge the paperwork, but they issue you with the CCJ within the first 30 days, 100%, if you pay it in full, you can get it removed. So, and a lot of the time, you can actually, another bit of the work that I do, it can be quite complicated, which is why sometimes clients will come to me because they're like, Ellie, you just deal with it. But a lot of the time, if you are willing to take ownership of the debt, you can actually negotiate with the other company and say, look, I've filed an appeal. This is what I owe you. This is what I'm happy to offer you to settle the balance. But in receipt of that, will you now reverse the judgment? Because if it's got as far as it going to the courts, that company knows that there's a possibility that that judgment might be removed anyway. Better they get their money and remove it.
Okay, so that's actually a service that you provide as 100%. Well, that you can do that.
Yeah.
Okay, amazing. So I'm sure there's going to be some people reaching out to you.
Yeah, it's funny. I get a lot of clients
from like their burner account first.
Yeah. They don't want to admit it.
They don't want to say it straight like, no, I'm asking for a friend.
Yeah. Not me, but someone I know. But yeah, funny enough, I get a lot of people, they're right at that point because they haven't bothered to check their credit report. They haven't bothered to stay on top of their credit. And then now they're at the point of buying a property or they're looking to invest and they're like, I'm literally at that point where I'm ready. And I've just realized I've got a CCJ because the lender told them. They didn't even find out. Now it's like, okay, right, now we've got to find 12 weeks to make sure that we get this removed. So now you can get the rates that you wanted to get. So,
of course. What are other services that you provide that you don't think enough people like take you up on or enough people actually look at?
I would say financial coaching. I could say insurance, but at the same time, I'm also known for insurance. But I think until everyone in the UK is insured, it's never going to be a service that I've been able to offer enough. Like everyone to some extent.
Why is insurance so important to you?
Because... Okay, so...
And when we say insurance, what type of insurance are you talking about for people that don't know?
I would say the 3 main ones for me, it's hard to pinpoint because everyone's circumstances are different, but the 3 main ones are income protection, critical illness, and life insurance.
Okay.
Those are the 3.
I like to do role play.
Let's go for it.
Which one should we start with?
Income protection.
Income protection. So, I'm a property developer. I'm going to say, listen... I don't need income protection because I have buy-to-let investments. They pay me regardless. So why would I take out income protection insurance?
Is there ever going to be a time that you are not in a position to work? So forget about passive income, forget what your occupation is, but are you immune to sickness?
No, I have a very bad immune system.
Okay, so what is the work that is required for you to maintain those properties, whether it be administration, whether it be having a conversation with your accountant, checking if your tenants have left the properties in the right condition or whatever? What's the work that you have to do as part of your day job in order to maintain that money coming in?
Yeah, no, there's a sizable amount of work.
Sizable amount
Yeah.
of work. And what would happen if you wasn't in a position to fulfill that work?
I would hope, like, some of the team I put in place, but obviously there's a reason why I have worked there is
So
stuff
you
that
said
falls
team.
on. Yeah.
Okay. So let's say there's MVPs basically in your team.
Yeah.
What would happen to your business if they were sick?
Yeah, no, that we're done.
You're done.
Yeah, no, we're
So
done.
sometimes income protection isn't always about you as the
Okay.
individual. Sometimes income protection is about you and your business.
I say, so for those who are not familiar, let's actually break down what income protection is.
Income protection is the policy that pays you monthly if you are too sick to work. So if your GP says, Kazy, he's not going to work today,
Yeah.
and he's not going to work for the next 3 months as well, he's done for. Okay? Doesn't matter what the condition is, doesn't matter what you're being signed off for. It could be your foot for all I care.
It was my foot most recently.
Oh, okay
Because
then.
we get older, we think we can still play football, and
Yeah.
it's in the boot, man.
Yeah, I
It's in
feel
the
like you
boot
guys
for
are
a
doing
little-
this a lot. You lot are getting to that age where you're
No,
realizing
we're at the age where we just say,
the joints aren't the same
Come on,
before.
man. We need to start the walking football, non-contact.
You said walking football, you know.
So you see, with the income protection, so
Yeah.
how does it work? Is it based off, for example, with somebody who's self-employed, is it based off their self-assessments, or is it based off what you submit your income as?
It's always going to be based off earnings. Income protection is the only policy that is based on income, so to speak. So if you're an employed individual, it's based on your salary gross. If you're self-employed, then there's two types of policies you can get. There is one where it's going to be based on your SA 302, etc., and that's of course your profits after expenses. Or it's going to be a capped policy, which means you don't have to provide any proof of income. The payout is obviously then going to be less because it is a capped policy, but you just have you've got the security of knowing that if your income can potentially fluctuate over the years, as business does, you don't have to worry about the proof that you're providing fluctuating as well.
Yeah.
But essentially, if you're signed off from work, you've got no money coming in, you are in a position to still receive an income. For the business owners, for the directors in your position, you're fine. You've got money coming in. You might be taking a salary or dividends from your company, which means that you are always going to earn regardless whether you're off next month or working next month. But for Rebecca or Simone or whoever's working in your business, if they take time off, your business now comes to a standstill. So now what we need is money in the pot to pay them, either
Okay, so
sick
you can
pay.
take it out.
Yep.
Yeah.
Or we need money in the pot so you can now go and find another Rebecca or another Simone whilst they're taking time off recovering.
Okay,
So your
okay.
business hasn't dipped in profits.
Okay. And I know it's, like how long is a piece of string, but what's like costs look like that on a monthly basis for these types of policies?
You're right. It is hard to vary because it's always based on age, smoker status, height and weight. But I usually say the best perspective, and of course income, the best perspective or the sort of best equation that I can say is, are you willing to sacrifice anywhere between 1% and 3% of your annual income to guarantee that same income no matter the circumstance?
Okay.
If we think of 1% of a 30K salary, for example, to guarantee that you still take home a 30K salary no matter the circumstances, it's a small sacrifice.
Yeah. No, you're a good saleswoman. You know what I mean?
You said saleswoman.
I'm warming. No, but in terms of, I say that because everything is sales. Everything we
Of
do,
course, yeah,
every conversation we have is like, we have this conversation and you're selling not your service, but the ability to deliver that service. You did that well. Okay, cool. What's the next one now?
Let's do life insurance. This one is, I've been in a situation, even myself, to be able to claim for income protection But life insurance is close to home because I've done even family members' claims and other individuals' claims. So I would say life insurance is,
Okay.
definitely
So
important.
for those that are not familiar, just give brief overview of what life insurance is, what it covers.
Basically covers an individual if they pass away. That's simple. You can name beneficiaries, so money gets paid directly to someone upon death. But essentially, if you've got life insurance in place, you've left money behind, no matter your circumstances, they can use the money as they see fit.
I feel like I just don't want to face the reality.
What, dying?
That I might die.
That is guaranteed.
Yeah, like I haven't really accepted it yet, to be honest.
You know what's crazy though? For many people, dying tomorrow, God forbid, is more likely than them winning £1 million or £1 million landing in their bank account. So from my perspective, or from that perspective, if you've got children or you've got loved ones that you're leaving behind, if dying is more guaranteed than £1 million, I'd rather £1 million insurance policy, because that's the likelihood. How can dying be more guaranteed than me getting £1 million from somewhere?
And what type of insurance policies do people tend to take out in terms of value? Is it the £1 million or is it generally quite a bit lower, higher?
Yeah, varies on their circumstances. Most common one is cover against their mortgage. So if they've got a £350,000 mortgage, they want to know that, it's going to be paid off if they pass away. So they got a policy to match exactly the term of the mortgage, the value of their mortgage. If it's children, they want to know that they've got money left behind to raise their children. I'm a mother. It cost, according to the government, it cost £180,000 to raise a child until the age of 18. To me, that's a lie. I feel like I've spent £180,000 on my 5-year-old already, just raising him. So again, it's about saying whether you're a single parent or two parents, the impact on someone else to raise your kid, and also the quality of life that you want your child to have. So if you're spending X amount of money on them every single month, you're not here. That income's gone. Okay. So you need to replace it.
And with this one, that's one where you just say, look, this is what I want my insurance coverage at, and then you'll get a quote based on the amount of cover that you want.
Yeah, to an extent. I, as an advisor, do cover based on what I feel the client needs. So I like to advise. So say, for example, you're my client. You will give me all of your information. You'll tell me a bit more about yourself. I'll ask you key questions that kind of give me a good overview. And then I will say, okay, right, we've got this amount of mortgages. We've got these children. We've got this scenario here. We've got this scenario there. These are the policies that I think you should have in place at this value.
Yeah.
Life insurance, income protection, you're not obligated to take what an advisor offers you. So you're then obviously in a position to say to me, Ella, that's great. Thanks for your advice, but I want this one.
Yeah.
No problem. But at least you've been given the expertise and the information to know what's available to you, and also why. The fact that it costs £180,000 to raise a child. So someone taking out a £50,000 life policy, if they pass away tomorrow, the £50,000 is only going so far. And especially when you now got quotes, when you can see the difference between a £50,000 policy and a £500,000 policy. Because again, you don't know what you don't know. A lot of people have a big misconception that insurance is really far more expensive than what it is. And it's not. It's as cost effective as you want to make it.
I think a lot of property developers, parents, people are like, listen, if I made all this money, yes, there might be some mortgages.
Yeah.
That's a you problem. But they're like, I've already leave you 10 houses.
Yeah.
And there's some mortgages. Amalgamate. And do you know what I mean?
Yeah, but then what about the inheritance tax? Say you haven't bought them within a limited company. Say you haven't put the company within a trust. Also, you know what the thing is? I hear a lot of people saying, I want to create generational wealth. And they're doing the wealth creating, and then they forgot about the generation. Who told you that your kids wanted to follow in your footsteps? Do you know what I mean? So it's not just always about creating the wealth. It's sometimes about tying up the loose ends so they can actually receive that wealth. And again, if someone said to you, okay, Kazy, I'm going to give you £100,000, but actually you've got to do this amount of work for it. You're like, oh, okay, this amount of work for £100,000. Then you do the work and then they're like, no, sorry, we're only going to give you 20. You're going to be thinking, hold on, but this is daylight robbery. It's the same when it comes to, buying property, the value of that property, the mortgages and etc. You might have in your head thought that you've created £2 million worth of generational wealth that's going to be passed on. But then if we deduct the value of the mortgages, if we then deduct the inheritance tax that's due, if we then deduct actually the fact that the family are missing you. You've just passed away. They don't want to deal with this nonsense. Then the solicitor fees going through probate, that £2 million might now be only
Yeah.
600K.
So I guess it's more like for a lot of people, it's kind of like the hedging of bets. Like that's obviously what the insurance premise is. That
100%. It's a contingency plan. It's not, we are not in America. It is not an investment where you take out £200,000 life insurance and you can, take out a loan against it, or an investment scheme. It's a contingency plan. If something happens tomorrow and I don't have this money in the bank, I can claim on my insurance. And the best one, for example, is car insurance. No one gets in their car and plans to crash.
Yeah.
But you damn well know if they do crash, they're going to make a claim on their car insurance, because who the hell wants to pay out the value of their car or the other person's car?
I think that's how someone got me. They just said, do you insure your car? I said, yeah. They said, do you like your car more than your legs? And I said, well, no.
No, and you're obligated
Yeah.
to drive with car insurance. But it's true. You don't get in your car and you plan to crash. I don't get up to today and tomorrow and plan to get sick. I don't plan to die, and I don't plan to be diagnosed with cancer or whatever. I take my ginger shots, go to the gym, try and keep us... It's just life at the end of the day. Do I have £180,000 to continue raising my child at any given moment? Do I have £350,000 to pay off the mortgage? Do I have all of this money available in the bank tomorrow if the worst was to happen? No. So there's my insurance.
Okay, fair enough. Like that's it. It's a good. Okay, let's get on to the next one we discussed briefly, very briefly, which was your financial coaching.
Okay.
What does that look like? What do you do as a financial coach?
I basically assess individuals' circumstances. They will come to me and they will have a pain point. I'm struggling with saving. I need to clear debt. I want to get better at finances. My main thing is just sort of creating them a roadmap and a blueprint. 9 times out of 10, they always want to buy a property because they feel like it's one of the easiest ways to create wealth, or it's just that milestone that they want to tick off, and they've just got no idea how to get there. So it's literally a roadmap of understanding where you are, where you plan to get to, and all of the steps that you need to take from start to finish. So I'll do like a financial audit with them to start off with. I'll ask them about their investments, their pensions, their savings, if they've got children, debts, etc. So we know exactly where their strengths are and where their weaknesses are. But then it's about understanding what goals it is that you really want to hit. And like I said, all of the steps, it's all well and good saying, I want to buy a property. Okay, when? What area? How much is the deposit? Is this area that you want to buy in going to appreciate in capital? Is this going to be a property? Is this your forever home? So therefore the capital appreciation doesn't really matter. Because if the capital appreciation does matter, then these are the things that we need to consider. Are we just going for one property, or are we going to 2? I feel like I see a lot of mistakes online where people will say, don't get a residential property first, just go for a buy to let. But now you've lost your first time buyer status, or people then forget the considerations about stamp duty. And so there's so many things that people have a goal, and it's all of these other considerations that are lacking centered around that goal. And it's just making sure that you've got a clear map of saying, this is A, this is B, and this is how I'm going to get there.
I think that's very true. I think a lot of people will just tell themselves, I want to buy a property, but I'm so far away from it.
Yeah.
Without any context of what that actually means.
Exactly.
And I use the example of like, you know that you can run, but someone says, can you run 3K in 12 minutes? Until you actually try and run it.
You've got no idea what your pace is, your time is.
Exactly. Where your issues are. Is it your breathing? Is it your legs? Do you have pain in your lower back? Like, what do you need to sort out to get to a point where you can achieve that? And I think for those that are interested, like a lot of you will be in buying your first home, next home, realistically having conversations with, whether it be financial advisors, brokers, downloading credit reports, are going to allow you to see how far you are away from something. And then you can set those manageable steps, baby steps to get to achieving your long-term goals.
Yeah, 100%. 100%.
You see, with all of the like credit agencies being separate.
Yeah.
Do you think that's a bit of a scam?
No, because there's Check My File where they're all in one place.
Okay.
So Check My File, subscription-based platform, pretty much, I think they're $14.99, which is the same as Experian anyway. To me, I think it's just about doing the homework. So I love Check My File because, again, like I said, it's 3 agencies all in one place. For the cost of the subscription with Experian, you can pay to Check My File. Experian are killing the game at the moment. The fact that they've got the credit lock, you know, they're in a... You're always going to have one industry leader.
I just like Experian because My credit score's highest on
Because it's
Experian.
999 with Experian, yeah.
Listen, talk to me nice.
Because it's 999. And in fairness, with Check My File, because it's an average of all three of the credit referencing agencies, it will be lower because it's an average. But it's just, again, understanding where you're at or what your credit report looks like from that perspective. Because this is the thing, not all of the lenders use all three agencies. I find most commonly mortgage lenders tend to use Equifax.
Equifax, yeah.
Yeah, most of the lenders.
Sometimes I'll send them Experian, and like, you send me Equifax, and I'm like, so I've got to spend £14
Yeah,
now.
logging into Equifax. And that's the thing. It is annoying. It is annoying that you do have to register with that subscription at that particular time, but you're not tied in. It's not a 12-month contract. And the truth of the matter is there are free platforms for each of the agencies. So if it's Experian, Money Saving Expert run an Experian club. I think they call it the Money Saving Credit Club.
Okay.
Allows you to access your Experian credit report for free. If it's Equifax, it's ClearScore. Allows you to access it for free. And if it's TransUnion, then it's Credit Karma. Allows you to access it for free. So if you're not going to spend the money with Check My File, which is all three, download the apps, access them for free until then you need to, and then spend your money with whatever agency.
Ella, it's been amazing having you on today. If people want to connect with you, I know there's going to be some people saying, I've got to get rid of those CCJs. I've got to get myself ready to get my property journey on the go. Maybe you can join the PBK community. How can they connect with you?
Follow me on Instagram, Ella Insures. Drop me a DM, drop me an email. But on all social media platforms, Ella Insures.
Okay, amazing. We're going to make sure we put the link in the description. If you haven't already subscribed, if you haven't already liked this video, if you haven't commented, make sure you do that right now. We're going to be back next week and each and every week going forward with another amazing guest. So I'll see you there.